Just going to be looking at the forthcoming week's analysis. So that's the 25th to the 30th of January, the last week of January. Just going to be starting with the euro against US dollar. And one of very much importance, as we all know, a lot of data came out this prior week. We've also had Draghi, who has now mentioned that they will be doing a quantitative easing program in the tune of 60 odd billion euros a month. So that's going to be interesting. And we've seen a lot of negativity playing out through the course of the first month of 2015. Notice that I mentioned in my prior videos that we saw a negative close to 2014. And in fact, the first time we've actually seen price closing below the institution moving average on the monthly time frame for the first time in as many years. In fact, I don't think we've seen price closing below this level or trading below the institution moving average since the 2000 period. So a very, very strong indication of negativity. And straight away you can see on the hard right edge here, looking at my monthly chart, you can see the indicator box is primarily picturing a lot of negativity, and the R squared is complementing a lot of that negative sentiment. So true negative sentiment. And clearly what we've seen this month, the first month of the 2015, you can clearly see the sentiment drive lower after that negative December close. So a very, very negative statement imposed through the end of 2014. A lot of negativity through most of the latter part of 2014 going into 2015, and the close lower has now constituted a very negative bias sentiment indication, and you can see the outcome of that. So looking at it overall, you can clearly see that we're still very much in a negative trend. We are seeing no new highs fundamentally since 2007, and in case we've seen a lot of negativity through most of 2014. In fact, breaking through that institution moving average, as I clearly mentioned. So the institution moving average acting as a support previously through 2010, 2011, 12, and December closed lower has led to what we're seeing right now. So if we look at drawing major support and resistance lines, I'll take the fib level from the all-time low that we saw back here in 2000. You'll notice that, if I can just take this out, you'll notice how price has moved between these fib levels over the years. In fact, the most important one that we've been using, or price has been using clearly over a number of years, has been this level over here, which is the 50% retracement. Now, it's not a fib level, it's just half between 0 and 100, but you can clearly see that price has clearly used this level in the past as a support level. And clearly what we've seen recently, i.e. December of 2014, is price trading into that level. But the most important thing of that was to notice that both the 50% fib level was used as a support or target level as we saw selling into it. But back here, we saw price actually supporting on the institution moving average, clearly also the fib level on the two prior occasions. This occasion, the price actually closing lower, and you can see how much negativity we've seen through January alone, and that's been fueled as the weeks have gone by for January because of clearly quantitative easing. There was no other choice but to introduce quantitative easing, which has been announced now by the ECB, which is going to take place to the tune of 60 billion euros per month in printing. But we also have a major announcement in the shape of the Greek vote, which is going to happen tomorrow, the 25th of January. And it's an important day for Eurozone because there's a potential likely change or introduction of a radical left group who's promising a number of things, and which could have a major impact on the Eurozone going forward. Not only in Greece, but the ripple effect will be felt throughout Eurozone and further abroad. So we are, and you can quite clearly see if I drop down now to a weekly time frame, we get a sell signal straight away because it's telling us we should still be looking for selling signals. Clearly we've seen that negativity playing through now on the weekly, but you can see price this past week has closed into that fib level, the 61.8, and roughly around the 1178. And I mentioned this would be a potential long-term target at the back end of December, in fact. So you should have been looking for that negativity. You should have actually been trading that negativity, and you should have been very much profitable on that outcome. This month alone, we've seen in excess of, if you look at the January start to the current low, in excess of 830 odd pips of movement. So that's a hell of a lot of movement, a lot of opportunities, and it's been there. You just got to be well aware of it, and you should have just been trading it. So now what price is doing is we're trading at a 61.8 fib level, a major support and resistance level, a target level, and that coincides now with the forthcoming election for the Greek tomorrow. It's going to be quite interesting because we could either see an outcome which would be one that could see price consolidating over here for a period of time before we see a recontinuation to the downside. The negativity tells us that we should still be looking for negative downside. So therefore, when we look at where price is trading right now, we would need obviously to see price closing back below that 61.8 level at the 11787 and change mark to then give us a valid re-entry to another level down here at the 76.4, the 78.6, both fib levels to the downside. And we're looking in excess here of roughly 1100 odd pips. So there's still a lot of movement for price if and when we can actually cross below that 61.8 fib level barrier support. So the Greek vote tomorrow, will it have an impact? Very much so. We are seeing a lot of negativity. It's inevitable we are going to see prices continue to fall for 2015. However, it'll be interesting to see how much momentum that fall or negativity actually outplays with the Greek vote outcome tomorrow. So be very vigilant, guys. We could see a lot of volatility at the start of tomorrow night's trading on Sunday evening for that 2-hour period. We could see a lot of volatility if and when we get the announcement. If there is clearly a change, there will be a lot of volume that will meet that outcome. So be very, very vigilant when you're looking at euro, trading the US dollar, or any euro crosses for that matter of fact. Moving on to sterling, here again, clearly see how January is playing out. A lot of negativity. Prices have been moving into a major support and resistance level, or trading into that level. You can quite clearly see that the month as it stands at the moment now is still very much negative. You'll notice that there's very little wick on this candle, so a lot of selling sentiment is genuine selling sentiment. There hasn't been any indecisiveness within that range, and you can clearly see the indicator box over here very much red in color. There are one or two periods where we're seeing blue. However, the overall sentiment, both monthly, weekly, daily, and 4-hour, very much telling us you should be looking for further bias to the downside, and you can see the outcome. Clearly, price has been quite consolidative if you stop dropping down now to weekly and daily time frame, primarily because prices are trading around a major support and resistance level in the past, which happens to be the January 2013 lows. So as it stands at the moment now, and we drop down, you can quite clearly see that we had a fantastic trend to the upside through June of 2013 to the current highs that we saw in June 2014. Subsequently, since then, we've seen sterling roll over, and we've seen a lot of negativity playing through as things in Europe have got worse, which has had a knock-on effect on the economy here in the UK. So clearly, you can quite clearly see a major negative trend in play, and we are pretty much trading below the no point of return level. We're pretty much heading back down towards those May 2013 lows, and we're not that far off. So we look at where price is trading right now to the level is in excess of 180 odd pips. So there's still more to the downside, but we are likely to see if we get below those 2013 levels. I was going to pan back up to that monthly. You can see how there's more movement to the downside. There's a slight consolidation area around here that we saw back in 2009, 2010. But overall, we're looking at that 2008, 2009 level, roughly around that level to constitute as a potential support or target level. Below that at 14154, in fact. But you can see how the sterling has been met with a lot of negativity recently. So as it stands at the moment now, we should be still looking for that bias for selling pressure to continue. You'll notice here, if I go down to the daily, we saw a lot of consolidation over the past couple of weeks. In fact, most of January we've seen consolidation. Price has been bearish. The bias is still to the downside. It's just not been as genuine in its stance. We saw Thursday closing lower, so clearly pushing lower, forming a new swing low. In fact, so back below that monthly fib level. So we should be targeting the 100% level, which as I mentioned to you is 180 odd pips to that level. So we should still be looking for that negative bias. So there again, the outcome of tomorrow's Greek vote would potentially have an influence on volume or volatility for this particular pair or any other pair on the four majors. So just be looking for that negative sentiment to continue to play out for the remainder of January going into February. US dollar Swiss franc, this one over here, also big news, game changer, was the Swiss National Bank coming out with their stance and unpegging the euro against the Swiss franc, or the Swiss franc unpegging the Swiss franc against the euro. Subsequently saw the biggest move we've seen prior to the 2008. We've seen a lot of pressure, a lot of brokers actually coming into a lot of stick, or closing for that matter. So we've seen a lot of negativity resulting on that. And you can quite clearly see up until that point when we had that major news announcement where we saw the Swiss National Bank cutting interest rates, we were looking for potential further bias for a strong US dollar against a weak against the Swiss franc. However, clearly you can see the outcome. This month, in fact, we've seen pretty much most of the last 4 years worth of trading, or this range of here, pretty much been taken away within one full day of trading. Quite impressive in terms of how much movement we saw that day. We looked in excess of 1950 odd pips. That's crazy, that type of momentum driven. And what it's clearly done now is you can see prices actually fallen to the 2014 lows, which were roughly around the 8788 and change level. That could be different, but you can quite clearly see that price is consolidated on this level on a number of occasions. So in terms of where the US dollar looks in terms of progression long term, you could see that up into the December period, we had a blue arrow. The candlestick was meeting that requirement. We actually saw the RMO trading above the zero level for the first time in as many years, and the OSMO was clearly above that as we saw this move to the upside through 2014 as positive sentiment for a very strong US dollar. However, as you can quite clearly see, if I just pan out now, you can see the trend is still very much to the downside, and you can see, however, the last couple of highs, trend highs coming through here, swing low, swing low, swing low, and you can see how that long-term trend has actually played an influence in price action at where price actually faltered. So as it stands at the moment now, the bias over here is clearly likely to be negative for the US dollar against the Swiss franc, primarily because of what's happened, because it's still not many new highs, in fact, on the monthly. And if I take the current high all the way up there in 2000 to the current low that we saw before the intervention that we saw in 2011, in fact, you can see that prices are trading around that 23.6 fib level. Major support and resistance level in the past year, 2007, 2008, 2009 support, was now currently resistance through 2012, 2013, and now at the end of 2014-15. So as long as we trade below that monthly fib level, then ideally we should be looking for further negativity. And you can quite clearly see that prices are trading around a major support and resistance level in terms of the 2014 lows. So therefore, if we drop down to a weekly time frame now, you can see that we've seen consolidation on the outcome of that prior week. So, and you can see the price now last week actually moving higher as people have taken profit. And if I take a fib level of the current high of that candle to the current low, you'll notice that prices is trading in and around that 23.6 fib level. And if we find prices failing to actually move higher around this consolidation area towards that 38.2, then we're likely to see further selling bias coming into the market and pushing prices further to the downside. So here, prices are trading at a major support and resistance level. This week, the data for the Greek the Greek vote, it's going to be fundamentally important to what happens going forward for this week. So we could see further volatility or speculative movement. However, with that major move, a counter trend for the US dollar Swiss franc, seems to be more bias on it. But you can clearly see that the long-term sentiment is still very much negative here, but you can see there's a lot of bias for upside movement. So here, be vigilant when you're trading because of the major move we've seen in the market recently. It'll be interesting to see, rather give the remainder of this month away or give it back to the market to see clear directional movement, because what could happen is we could see price moving back within this consolidated range, or we could see a continuation on the outcome of what happened just recently. Last pair is going to be the US dollar Japanese yen on the monthly. Here again, you saw December spinning top. Yeah, it closed higher than the prior month. However, nonetheless, still indecisive, and you can see the outcome of this month. In fact, the first month of January, you can see that we've had a pullback. However, the starters, we're starting to trade at the upper end of that. The long-term sentiment over here on the indicator box primarily telling we should be looking for further highs. However, intraday, on our smaller time frames, clearly that bias is not reflecting that, and that bias should be reflecting indecisiveness, because we saw an indecision candle the prior month. So looking at this overall, you can see the all-time highs we saw way back over here, but you can see where price is trading right now on the hard right edge in comparison to where she was trading in the past. And clearly we're trading at a major support and resistance level, or consolidation level, that we saw through most of 2005, 2006. So the all-time high to the current all-time low, you can see the fib level over here clearly in play. Okay, which happens to be, let me just get this, there we go. So clearly what we should be looking for is consolidation at the 61.8 level. Ideally, if we are to see any further bias or bullish bias for the US dollar against the weak yen, then we need to see the 61.8 here at 120.47 and change being broken or closed higher above for us to see, even contemplate any further highs. As you can quite clearly see here on the monthly, if I just pan in, you can see that price has been consolidative now, and if we don't see any further highs or new highs sometime soon, then we could see further bearish sentiment creeping in, which would then push price back to prior support and resistance level, or fib levels in this case, which would be the 50% fib level here at 112.152 and change. So down to the weekly time frame, clearly see no new highs. In fact, we had a bearish engulfing candle which engulfed the prior 2 weeks, and we've seen prices pushing lower. Price is trading under a price support and resistance level here, which happens to be the November-December start of 2014. Indecisive the prior week, and this week further indecision. Okay, so not a lot of movement on the US dollar Japanese yen this previous week. In fact, very indecisive and ranging. If you say you go down to a daily time frame, you can see very much ranging, not a lot of real true momentum there. The last couple of days, in fact, have been absolutely shocking. So, and that just coincides. So very, very important. If we are to see any further movement for the US dollar Japanese yen, which would have to be upside, we would need to see the current level here at 61.8 at 120.47 being broken, and price moving, kicking on. The longer she fails to make new highs, then there's likely to be further negative sentiment creeping in, which is then going to force price lower, and ideally back towards that institution moving average, which will creep up as price or time moves on, which could coincide quite nicely here with a 50% retracement level here at 112.152. So here, looking for more of a directional candle to then contemplate where we're likely to put our money on the table going forward. Until then, I'd like you to stand aside and wait for a clear directional until that happens. So US dollar Japanese yen here again, stand aside, wait for a clear directional candle, and then trade the outcome. That's it. Short and sweet, to the point. Please be aware, as I mentioned at the start of this video, that tomorrow, the 25th of January, Sunday, the 25th of January, is the Greek parliamentary election, and the radical left Syriza group, I hope I spelled that right, is looking likely to take power, which could be quite detrimental to both Greeks' long-term involvement with the Eurozone going forward. So it's going to be quite an important impact news announcement, and it would have an effect going forward for the week. So be vigilant, be well aware of what the outcome is, so that we can factor it into our trading going forward. So I hope you have a fantastic trading week. Keep it simple, as I keep mentioning on all my videos. Trading is difficult as it is. You don't want to overcomplicate it. Just keep it as simple as possible, and you'll find it a lot easier going forward. So keep it simple, and I will see you guys the following week. Until then, you guys trade serenely.